In the webinar today, we're going to look at the question of what is smart beta, who is investing in it and why, and how to measure the risk-return characteristics of different smart beta approaches. My name is Paul Amery. I'm the contributing editor to Index Universe based in London. I'll be moderating this afternoon's event. We're joined today by Felix Goltz, Head of Applied Research at the Edhec-Risk Institute, which is sponsoring this webinar. Also by Mark Voermans, who's Senior Strategist at PGGM Investments, and by Peter Sleep, who's Senior Portfolio Manager at 7 Investment Management. You can submit, for those of you listening in, you can submit a question to the panelists at any point during the next hour. What you have to do is to type your question into the Q&A box at the lower right-hand corner of your screen and click the send button. Felix of Edhec-Risk Institute will be making a presentation for the first part of the webinar, after which we'll move on to the question and answer session, and we'll be collecting and passing on to the panelists the questions coming in from those listening into the webinar. So please type your question in at any time and we'll attempt to answer them all at the end of the webinar. With that, I'd like to hand the controls over to Felix, and Felix will be presenting to you on the topic of the webinar, what is smart beta?
Thank you very much, Paul, for this introduction, and welcome to our participants for to this webinar. So I would like to provide some insights really on the smart beta equity strategies that are increasingly popular actually in the indexing industry. There have been a large number of new types of equity indices that have been launched roughly over the past 5 to 10 years. And the development of strategy indices or alternative weighted equity indices has really gained a lot of momentum. If you look at the number of product launches in this area, there is a great number of products, and really this trend that index providers launch ever new indices and a larger number of indices is actually still continuing. So we actually looked at this recently just to get an idea of the sheer number of products, and just by looking at the press releases by major index providers, we actually counted over the past 3 years that there was about a new index being launched every week on average. And when I mean new index, I mean a new index series, and of course within these index series there will typically be multiple indices for different regions and so forth. So we can clearly see that there is a huge number of alternatives out there now for investors. Quite often this is actually being questioned or perhaps criticized. Investors ask, do they actually need more indices than they have stocks in a typical global index universe? And clearly if you count the number of different smart beta indices and different types of strategy indices, we're clearly now at a stage where the number of indices is probably higher than the number of stocks that people can invest in. So there is a reasonable question from investors to ask, well, do I really need all these indices, and what do I get out of having this variety? And I would argue, and I will argue today, that these developments are probably opportunities for investors. So I think it is a good thing that finally we're spending more time to think about the choice of the benchmark. This is really a first order question in portfolio management, and historically people have actually stuck to a default choice, which is the cap weighted index. So having this questioning of the cap weighted index and having actually some thinking about what is the right way to construct a benchmark is definitely a good thing, and it's useful that the industry spends some time thinking about not just how to generate alpha over a given benchmark, but also how to define that benchmark in the first place. So it's a good thing that finally we are asking the important questions, and that there's increasing attention to this. And secondly, I think it's also a good thing that there is choice for investors. In principle, choice should always be a good thing for investors. And if investors look at this variety of indices critically, I think it is also because they have difficulty to make an informed choice, and they don't necessarily have all the information that they need to properly assess these new forms of indices. And indeed, there are a number of challenges when you think about how to assess the returns, the benefits, and also the risk of these new forms of indices. So this will be my main focus, actually, to talk about how we can assess these indices and how we can better understand the performance and also the risks of these different weighting schemes. So just to provide you with an introduction on what are these smart beta strategies, first of all, I think it's useful to just quickly define what we're talking about here. So when I say smart beta strategies, what I'm referring to is really any systematic portfolio construction that comes up with a benchmark that deviates in some sense from the traditional cap-weighted market index. When you think about a traditional cap-weighted market index, you can see that there is a stock selection choice. So you select assets out of the complete universe. That's the first step. And then there is a second step, which is a weighting choice of the weighting scheme. And in the traditional cap-weighted index, of course, both of these steps are entirely driven by the market cap. You select stocks by the market cap, and you weight them by the market cap. So basically, smart beta equity indices are any form of index that will deviate from the market cap as the main ingredient in either of these steps in the index construction. So cap-weighted indices, of course, have been the starting point. There hasn't been much thinking about what the right benchmark should be. It was by default a cap-weighted index. And now these smart beta strategies have come around and actually try to come up with alternatives of weighting and stocks and selecting stocks. Now there are two main categories of these. You could even say there are two main camps in the promoters of these smart beta strategies. And the first camp, if you will, is really the proponents of fundamental weighting approaches. So the idea behind fundamental weighting approaches is really to go back from using the market cap as the main criterion for the firm size and actually to choose some alternative measure of the firm size. So typically providers use a combination of fundamental measures, for example, things like the dividends paid by the firm, the book value of the firm, the earnings of the firm, and similar measures. So fundamental indices are really based on the idea that there is a problem with using the market cap, and the main problem outlined by promoters of fundamental indices is really that the market cap actually integrates the price of the stock, and so the main criticism of the cap-weighted index coming from fundamental index providers is really, they say that, basically including the price in the definition of the stock weight will actually tend to lead to an overweight of the expensive stocks. And if you avoid that overweighting of the expensive stocks, then you will avoid this performance problems with the cap-weighted index. Another group of strategies is what I call diversification approaches. So the idea here is not to come up with a better proxy of the firm size, but the idea here is really to go back to the basics of portfolio construction and think about diversification. Okay, the objective here is to obtain a well-diversified portfolio, and this is a way of addressing another criticism with cap-weighted indices, and this has to do with concentration. Okay, so cap-weighted indices have been criticized for being highly concentrated. Typically, you hold a huge proportion of the weight in just very few stocks. Okay, and what is worse, not only are you concentrated in a few stocks, but typically you tend to concentrate in stocks that have similar characteristics and come from similar industries, for example. Okay, so you could end up having very high weight and highly correlated stocks. And this is really not what you would do from the perspective of diversification. So all these diversification approaches are really ways of creating a better diversified portfolio. There's a whole host of approaches, because when you say that you want to diversify better, well, they haven't actually said much. You still have to define what your precise objective is of diversification. So in this category, we have approaches that are based on mean variance portfolios, such as minimum volatility approaches or maximum Sharpe ratio approaches. But we also have other forms of diversification, things such as, for example, equal weighted or maximum deconcentration portfolios, things like equal risk contribution. So all these are ways of, if you will, creating more diversified or more balanced portfolios and take into account mainly the risk characteristics of these stocks. So these are the two different groups of smart beta strategies. Now, when you look at the main arguments from providers of these strategies, the main argument behind adopting one of these indices is clearly the outperformance with respect to the cap-weighted index. So by avoiding the use of price or by diversifying in a better way, you will have better performance than with a cap-weighted index. So this is a reasonable claim. It has been widely documented that these strategies have the capacity to outperform the cap-weighted index. But clearly, when you talk about outperformance, there is a question on what is the risk behind generating that outperformance. Now, when investors choose an active manager to generate outperformance, they immediately ask the question of what is the manager risk? What is the risk related to investing in that manager, to his strategy? And with these smart beta indices, you have exactly the same question. So what is the strategy risk? Now, it is clear that when you look at publications in the industry, this question of risk is still a somewhat neglected question, even though there has been, some progress has been made, and I will try to address that in more detail. An important point also to understand with these smart beta strategies is that it is difficult to evaluate the performance and the drivers of the performance of these indices because the indices provided by index provider, but also by asset managers, for example, are typically really bundles of methodological choices. So you actually get a kind of package that combines some form of stock selection with some form of weighting scheme, and you don't necessarily get a good idea of which parts of the methodology contribute actually to that to that final result in terms of performance, and you don't necessarily get a good reporting and a kind of exhaustive idea on the risk factors that this strategy is exposed to. So clearly, as these smart beta strategies get adopted more widely, and as they start to make up not just marginal fractions of investors' portfolios, it is really useful to ask the question on what is actually the risk behind these strategies, and I will address that question of risk. Now, just to clarify this, asking what are the risks, is not at all a criticism of these strategies. Clearly, taking on some risk relative to the cap-weighted, default weighting scheme could be very reasonable because, again, it has been widely documented that there is capacity to generate outperformance. But clearly, investors should be aware of what the risks are. These risks should be documented, and investors should, in principle, have a way of making explicit choices in terms of risks, and not just go to some package of strategy and accept whatever implicit risk is embedded in that kind of strategy. So I structured the presentation around three types of risk that I want to address. And provide some illustrations. So first of all, the first type of risk that investors take with these smart beta strategies is what I refer to as systematic risk. Okay, so if you deviate from cap weighting, you will end up being exposed to well-known risk factors such as value, such as small cap, and potentially other risk factors. So I will talk about how you can measure these and how you can address these types of risk. A second issue is the specific risk of a strategy. So think about what happens when you move away from cap weighting. You have to bring in some sort of information into your portfolio construction, right? You're not just using the market cap, you're going to use other types of information, fundamental data, risk proxies for different stocks. You bring in more information, and when you do that, well, you can go wrong on the type of information that you're using. Okay, you could actually have a wrong idea of the fundamental size of the firm. You could have a wrong idea of the risk of volatility, for example, of an asset. So you're trying to improve on cap weighting by having a richer set of information, but that also means you can go wrong when you're trying to figure out what the stock characteristics are, what the risks are. So I'll explain that in some detail. And the final point is that smart beta weighting schemes will also bring in some relative risk. Okay, so relative to the cap weighted benchmark. Now this is of course expected when you deviate from market cap weighting. Of course you introduce some risk of underperformance with that market cap weighting scheme, and I will show that this risk of underperformance can be very important, and I will also show that you can use actually systematic approaches to reduce that risk of underperformance if that's relevant to you. So I will discuss this in more detail as well. Now let me provide you with some illustrations on systematic risk. So I think investors now ask questions on systematic risk much more frequently. In the early days, when the first papers were published on some of these new weighting schemes, it was very rare to find information on very simple things like, for example, value exposure, small cap exposure. Okay, so in the early papers, in particular on some of the fundamental weighted strategies, you find papers where there is actually no performance attribution showing us how much of the performance can be attributed to value exposure, for example. And even currently, if you look at some of the reports that are published on some of these strategies, providers often do not report performance attribution where they adjust for exposures to these very well-known factors like the value factor. So clearly, investors ask questions on systematic risk exposures more frequently now, but it's still not completely common to report all of these exposures and the corresponding performance attribution. So I will just provide you with two illustrations just showing that systematic risks can matter with these smart beta strategies. So first let's look at fundamental weighted indices. So here I'm looking at a kind of different fundamentally weighted strategies from different index providers. And we're looking here at different factors exposures. So we're looking at, first of all, the alpha generated by those strategies, the market exposure, the small cap exposure, and then also the value and the momentum exposure. What you can see here is that all of these strategies have significant exposure to the value factor. That's the line in the table that is highlighted here. So all of them actually take on significant exposure. There's a positive value beta, and this is in bold because it is statistically significant. So clearly, when investors choose this kind of index, they should check whether they're actually happy with having this kind of value exposure. Another type of exposure that arises is a small cap exposure, and I will illustrate this with equal weighted indices. So here we're showing a set of so-called maximum deconcentration indices. So this is just an adjusted equal weight where you adjust for kind of liquidity issues and turnover. So you're trying to have an equal weighted portfolio that is easy to implement. And here you see the small cap exposure of these portfolios. Now you can see that all of these strategies, this is across different regions, have a pronounced small cap exposure, and this makes perfect sense. By moving away from the market cap weights to more balanced weights, you will of course have more weight in the smaller capitalizations relative to those market cap weights. You will kind of mechanically end up with some small cap exposure, and that's what is shown here in the slide. Now these risk exposures exist within the smart beta strategies, but of course you can try to adjust the strategy to avoid some of these risk exposures. Okay, so this is what I'm going to show you is some illustrations to go beyond, let's say, very plain vanilla, packages of indices, and actually try to adjust the index to obtain the desired control in terms of risk exposure. So there's two things you can do. The first thing, you can have stock selection where you avoid, for example, the stocks that have the highest exposure to value. Okay, so if you do that, applying any weighting scheme on a set of stocks that don't include any pure value stocks, you should have definitely less value exposure than applying the same weighting schemes to all of the stocks with no control. So stock selection can be a very simple way to control these risk exposures. You can also do something a little more precise, a little more subtle, which is you can of course apply the weighting scheme and set some constraints in the weighting scheme. Okay, so you can think about things like sector constraints, for example, making sure that you apply the weighting scheme subject to equal sector exposures, for example, to the standard cap-weighted index. So let me just show you two illustrations for this. So first of all, I will have a look here at some results from a paper we published last year in Journal of Portfolio Management, where we actually looked at combining different types of stock selections with different diversification-based weighting schemes. Okay, so we selected stocks based on things like the size, the market cap, based on their value characteristics, based on their volatility, and then applied weighting schemes such as minimum volatility to these stock selections. And we actually showed that across different weighting schemes and across different stock characteristics, you can effectively control your risk exposures with this simple approach. Here I'm just showing an extract of that paper. So I'm showing here a global minimum volatility portfolio. So this is a kind of a typical minimum volatility weighting scheme. And I'm just showing here what happens when you apply that weighting scheme to different stock universes where you try to control for the size, for the market cap. So what you have here in the first column where it's written all stocks is simply the results that you get when you run a minimum volatility strategy on all US stocks. So this is a US kind of standard index universe. And you can see that here's a negative exposure. So note that this is big minus small. Okay, so this means a tilt towards the small caps. Okay, so just as expected, when you move away from cap weighting, you actually get a tilt towards the small caps. Now you can apply the same weighting scheme to a selection of stocks where you're only looking at the largest stocks in the universe. Okay, so we've looked here at just selecting the top part of the universe, just the largest market caps, and we apply the minimum volatility scheme. And what you see here in the right-hand column is the resulting exposure within only the largest market caps, and you can see here that this exposure of 1.83% is very close to zero, and it is statistically speaking insignificant. So it's indistinguishably different from zero. Okay, so we actually avoid any small cap exposure here by actually applying the weighting scheme to the largest stocks. So if this small cap exposure is not desired by an investor, there's something that he can do about it. Okay, so now the next question is, well, what happens in terms of achieving the objective of that weighting scheme? And what we can see is that, well, the reduction in volatility that we get, and this is of course the objective of the minimum volatility strategy, well, that reduction is actually relatively similar to the case where we apply the minimum volatility weighting to the full set of stocks in the universe. So of course volatility is slightly higher. Okay, you can see it goes from 12.4 to around 12.6%, but that's a very small difference. So even within this smaller universe, you can actually effectively reduce volatility using that weighting scheme while avoiding this small cap tilt. And so this may be appropriate if, as an investor, you're not happy to take on this small cap tilt. I mentioned another example of risk exposure. So this is the sector exposure. So again, here I'm showing an illustration with a minimum volatility strategy, and you see here the difference in sector weights with respect to a cap-weighted benchmark in the same universe. And you have here quite a standard result for minimum volatility strategies, you see that the strategy tilts towards defensive sectors, in particular non-cyclical consumer goods and utilities, and this is very common with minimum volatility strategies. You can see that the strategy tilts away from more aggressive sectors like financials and technology, for example. And again, this is a result that has been well documented for minimum volatility strategies. So if your objective is to reduce volatility and you want to accept the sector exposure, then that's of course fine. You can accept this kind of standard strategy. If for some reason an investor wants to avoid taking on sector risk that is different from the cap-weighted index, well, he can actually control this sector risk by using constraints. So I'm showing here an illustration where we have implemented the minimum volatility weighting scheme with a sector control. Okay, and you have here the results for the minimum volatility standard strategy, and then we compare this to the sector neutral strategy. So here we have constraints that make sure that the sector weights just match the sector weights of the standard cap-weighted index. And you can see that the volatility in the constraint version goes up relative to the minimum volatility strategy, but still there is a considerable reduction in volatility relative to the standard cap-weighted index. So if you have an objective of lowering volatility, but you do not want to accept the sector risk, the sector tilts of a minimum volatility strategy, well, you can actually implement the strategy subject to risk constraints, and you will still improve your objective while avoiding to take on these undesirable risks. So what these illustrations really show is that smart beta strategies are exposed significantly to different forms of systematic risk. You get things like value tilts, small cap tilts, you get sector tilts away from the cap-weighted index. But if these tilts are undesirable to an investor, well, first of all, you should know about these tilts, so it's important to document them. But secondly, there's something you can do about it. If you know about these tilts and you don't desire these kind of risk exposures, you can actually change your smart beta index to include some form of constraints. Now, another type of risk that I mentioned is specific risk, strategy-specific risk. And this is quite different from the systematic risk. So let me kind of try to define what I mean by systematic risk and why this is important. So systematic risk really refers to, specific risk really refers to, what is specific to each strategy. Okay, of course, a given strategy will take on exposures to things like value and small cap, just like an active manager would, typically take on exposure to factors like value and small cap. But of course, an active manager also has some specific risks. They are related to his investment process. How does he make decisions? How does he process information? And smart beta strategies have a similar risk. Okay, so by deviating from the market cap and by bringing in some information on risk parameters, on kind of fundamental firm characteristics, you're taking on some specific risk because you could actually go wrong in how the strategy is constructed. You can distinguish two types of risk. The first one is parameter estimation risk, and the second one is optimality risk. Okay, so parameter estimation risk is basically the risk of making some error on the information that you bring in. Okay, so let's say that you have a minimum volatility strategy. Well, you will go wrong to some degree in terms of the information that you are using on the volatilities across stocks and on the correlations, for example, across stocks. Okay, so using this information may help you to improve upon the cap-weighted index, but you will also go wrong to some degree when you try to use that information. Likewise, if you use, for example, a fundamental weighted index, well, you're trying to come up with some proxy of the firm size, so you could go wrong in estimating the firm size. For example, you probably know that in a lot of these fundamentally weighted indices, you actually have quite backward-looking variables. You look at, for example, the sales of a company over the past 5 years, over the past 3 years, so that may not be a good measurement of the current size of the firm, which is what you're ultimately interested in. So you're making some parameter estimation risk. But you're also making you're taking some optimality risk. Okay, so let's say that you are using a minimum volatility strategy. Well, you know that that minimum volatility strategy is not the optimal strategy. Okay, so the optimal strategy, according to textbooks, kind of textbook theory, is a maximum Sharpe ratio strategy. In the minimum volatility strategy, you will be away from this kind of truly optimal strategy that investors ultimately want to hold. Now, the interesting thing is that there is actually a trade-off here between the parameter estimation risk and the optimality risk. And let me just try to illustrate that trade-off to you with a simple illustration. So this is a simulation-based study. We're generating scenarios here. And we're showing what happens if you use different types of weighting schemes. And we're looking at two cases. So the first case is we say that there is no parameter estimation risk. Okay, you can observe the true risk and return parameters. That's of course highly unrealistic. And the second case is where you have some error when you're trying to measure these forms of risks. Okay, and here you can illustrate the optimality risk and the parameter estimation risk. So look at, for example, the minimum volatility and the equal weighted strategy. The equal weighted strategy has a lot of optimality risk, right? Equal weights are not theoretically optimal. Okay, they would only be optimal if all the risk and return parameters are the same. That's not likely to be the case. So there is a lot of optimality risk. At the same time, with equal weighting, you are actually not trying to estimate any parameters. Okay, you're completely ignoring any information on the risk and return differences across stocks. So equal weighting has a very low level of parameter estimation risk, but actually has this optimality risk. So here you see, for example, that equal weighting is quite far from minimum volatility if you look at the Sharpe ratios you obtain if there was no estimation risk. Now, of course, the realistic case is that there will be some estimation risk, and it's interesting to think about what happens when you have estimation risk. So here again you have, this is the second column with numbers here. You have a comparison between the minimum volatility and the equal weighted strategy. These are the average Sharpe ratios across our simulations. So you can see here, for example, that the minimum volatility strategy here has a better Sharpe ratio than the equal weighted strategy. So what that means is that estimating some parameters and using information on risk parameters actually improves upon the simple equal weighted strategy in this illustration. So even though you take on parameter estimation risk with a minimum volatility strategy relative to equal weighting, you're actually doing a better job, because you're exploiting information and you're closer to the truly optimal portfolio. So the minimum volatility portfolio here has a Sharpe ratio of 0.9. The equal weighted strategy has a Sharpe ratio of 0.6. Now, what is interesting is actually thinking about combining these strategies. Okay, so naively by looking at this, you may say that, well, the minimum volatility strategy here has the highest Sharpe ratio. Okay, it's higher than the Sharpe ratio of the equal weighted strategy, so I should probably, invest in the minimum volatility strategy rather than into equal weighting. However, look at what happens when you combine these two strategies. And here we look at a combination of equal weighting and minimum volatility, just a simple 50-50 combination. And you can see that the average Sharpe ratio we obtain across our simulations actually increases. Okay, so combining these two strategies gives you a better result than holding even the best of these strategies. So this is a typical result that you can get when you have a diversification effect. Okay, so if you will, the whole is not just the sum of its parts, it's actually more than that. Okay, you get something interesting that happens when you combine these strategies, and the effect you see here is actually an effect of diversifying away this strategy-specific risk. Okay, so intuitively, diversifying away specific risk makes a lot of sense. If you think about investors, investing in different active managers, it's very rare to find an investor who's trying to find the single best active manager. Okay, typically investors combine across different active managers precisely because they know that there's some specific risk and want to have some diversification across managers. So in the same way, it's actually interesting to think about diversification across strategies as well. You can diversify away this strategy specific risk and this will provide you with better results in terms of risk return. Okay, so it's important to analyze the strategy specific risk, but whatever you do in terms of understanding these risks of the strategies, be it systematic risk, be it specific risks, when you move away from cap weighting, you will naturally have some form of relative risk. Okay, this seems entirely obvious by not tracking the cap weighted index, but having a different way of constructing your benchmark, you will take risk relative to that benchmark. And this risk is quite often not discussed in the context of smart beta strategies. It's quite surprising that that's not the case. Again, if you draw a parallel with investing in active managers, when investors allocate money to active managers, they always will fix a tracking error budget. Okay, and you never see cases where investors compare results obtained by two different managers, right, without adjusting for the tracking error budget. You take one manager, you give him a 2% tracking error target, and ask him to respect that. You take another manager, you give him a 5% tracking error target. It wouldn't be fair to compare the performance, the returns in excess of the standard index of these two managers. You should take into account the fact that they're not using up the same risk budget. Okay, so this is really an important question. It's also important from a very practical perspective. So clearly, when investors choose an alternative weighting scheme, they choose a new type of benchmark. This is a very fundamental decision that typically means a lot of career risk for chief investment officers, for example, or for the investment management team within an institutional investment management organization. And this relative risk, is something, of course, that will lead to questions from stakeholders when there is a period of underperformance with respect to the cap-weighted benchmark. Well, then, this question of having adopted a non-cap-weighted benchmark will obviously be questioned. And again, the situation is very different here from the case of active managers. When you think about selecting active managers, there are all sorts of processes in place that, in the end will lead to the firing of a manager who will underperform. But when you change your benchmark, then obviously you're taking on a significant amount of reputation risk in cases of underperformance. So how big is this risk, this relative performance risk? Well, here I'm showing some illustrations. So these are numbers on a set of US indices. So these are, you see a set of different weighting schemes, like a minimum volatility weighting scheme, a maximum Sharpe ratio weighting scheme, a maximum decorrelation weighting scheme, and a maximum deconcentration. So maximum deconcentration is just a way of eco-weighting while adjusting for implementation concerns. So these are all different diversification-based strategies that people use. And you here have in the first panel a result where you implement these strategies with no tracking error control. And you can see the excess return over the cap-weighted index, but you can also see the tracking error, and you can see the extreme relative risk that you take on when you follow these strategies. So we have, for example, the maximum relative drawdown. So the maximum relative drawdown is just the worst underperformance that can happen if you switch from the cap-weighted index into this smart beta index at the exactly wrong moment in time, and then you switch back to the cap-weighted index again at the worst point in time. What is the kind of materialized underperformance that you will get? But here you can see that even if you look at relatively short time horizons of about 10 years, as is done here, the maximum relative drawdown of these strategies is quite often higher than 10%. Okay, so this is a huge amount of relative risk. Okay, think about a chief investment officer who adopts, for example, an adjusted eco-weighted strategy. Okay, it has outperformance over the entire period. You can see it's about 2% over the cap-weighted index. But over a specific period, it actually underperformed by almost 14%. Okay, so this will clearly lead to questions on whether this has been a good benchmark that has been selected. Now, what you can actually do to alleviate this relative risk is you can impose relative risk control. Okay, so here we're looking at results where we have implemented a hedging approach. Okay, so what we're trying to do is we're trying to make sure that the smart beta strategy is aligned with the cat-weighted index in terms of the risk exposures, okay, so the exposures to the main risk factors, and we're also using a control on the target tracking error. So you can see that when you do that, you will have less excess return compared to the unconstrained case, but you also have less relative extreme risk. Okay, so you can clearly see there is a risk-return trade-off. If investors are not able to take on these amounts of extreme relative risk, risk of 10% underperformance, they could perhaps use these smart beta strategies, if you will, in a more modest way, okay, by having something that is behaving more closely to the cat-weighted index and generates less outperformance, but also has less extreme risk. So this is another, I think, important risk for investors, this relative risk, and there's also different ways of controlling this risk. So what I try to do is really just try to give you an overview of the different risk exposures of these smart beta strategies. So, clearly I think investors should ask these questions. If they are comparing smart beta strategies, they are analyzing them, they should ask questions on this, systematic risk. They should ask questions on the relative performance risk, and they should definitely ask questions on the specific risk of the strategy, how are parameters estimated, how robust, if you will, are these parameters, what are the assumptions behind the strategy. So these kind of aspects related to specific risk are important. And this is clearly something that is not done enough in practice. Now, going beyond simply asking questions about risk and trying to kind of better document these risks, it's clearly important also that investors are able to make their own choices on these risk exposures. And this should be recognized. If you think about the risk characteristics of a given benchmark, the risk characteristics of a smart beta strategy that an investor will choose, it doesn't actually make much sense to discuss generic indices. Okay, so currently you have quite often comparisons across different indices that don't make a lot of sense, okay, because the conclusions of these comparisons will be conclusions whether the minimum volatility strategy has, for example, higher tracking error than, let's say, fundamentally weighted strategy. Okay, and these questions don't make much sense to start with, because the risk exposure of a minimum volatility strategy, for example, will depend, of course, very much on how you construct that strategy and what kind of risk controls you actually implement with that strategy. Okay, so quite often minimum volatility strategies are criticized for having very heavy sector tilts towards defensive stocks. Well, that is a fair criticism, but we should recognize that you can control these risks. So in the end, it doesn't make much sense to talk about the minimum volatility index per se. We should recognize that there's actually many ways of designing a minimum volatility strategy with different types of risk controls, and the results for the investor will clearly depend on that. So I try to give an overview of these types of risks with smart beta strategies, and to get back to the starting point on diversity across these different smart beta offerings. Well, clearly my point is not to say that the fact that these risk exposures exist is negative news for investors. I mean, clearly taking on these types of risks is rewarded. Okay, we have a wide range of studies that document the potential outperformance of these strategies. But clearly, if investors want to really use these strategies and not have bad surprises with these strategies, they should think closely about what are the risks. And when they think about these risks, they should also consider the options that they have to control these risks. So, it's for an investor, it probably doesn't make much sense to depend on implicit risks that are embedded in some standard solution from providers, but they should think carefully about where they want to be in terms of the risk exposures. And this, should also be a way of really, making these strategies more popular and allowing more investors to adopt them. Thank you very much for your attention. So I will hand back for discussion, and I'll be interested, of course, in comments from the panelists and questions. Thank you.
Thanks very much, Felix. This is Paul Amory from Index Universe. Thank you very much, Felix, for a very interesting presentation. We have about 15 minutes left for the Q&A part, and we have a number of questions that have already been submitted. But I'd like to start with one question for you, and then follow up with a question for Mark and for Peter. Felix, I mean, you referred to existing smart beta indices as being pre-packaged bundles of methodological choices, and your colleague Noah Lamonck, who gave Index Universe an interview recently, said that the investors may be the prisoners of index providers who impose decisions on them that can result in exposures to small cap risks or liquidity risks and so on. But most investors know that these smart beta strategies have such value in small cap tilts, and is it also not true that some of the subjective choices that index providers may make, such as limitations to turnover, actually work in the investor's interest? So is it not over dramatizing things a bit to say that people are exposed to pre-packaged bundles of risks that people have already decided for investors?
Thank you for the question. Yes, I mean, I think the strategies that investors have at their disposal, of course, they can accept them, and they can, of course, be happy to take on these risks that are embedded in standard strategies. Okay, so it's not necessarily the case that these strategies are not well designed. So of course, index providers are kind of careful in designing their strategies. However, I think it's not reasonable to believe that you need only one strategy that would suit all investors. And clearly you have some debate in this area. So there have been comments, for example, on some of the defensive strategies where investors criticize some of the minimum volatility strategies to be overly constrained in terms of their constraints in terms of sector exposures. Investors have criticized kind of other more simple low volatility strategies for leading actually to dramatic exposures in terms of sectors. And so clearly it doesn't make much sense to think that there's only one answer to actually having the right exposure to sector risk, for example, in a defensive strategy. In the end, this is a question that a product provider cannot answer. It's only a question that investors can answer for themselves, whether they're happy or not to take on these risks. So I think, in a sense, the industry set off in a very favorable direction, which is to say, well, let's think about this question of the benchmark. And now you have more choice, so more choice is good. But then, in the end, by just having these standard solutions, you actually, fall short of providing, a true kind of precise choice to investors in terms of where they want to be exposed. Similar comment on relative risk. Okay, so there have been cases where investors have adopted these strategies and have been disappointed by realizations of relative risk that they have faced. And so I think the industry still has progress to make on documenting these risks. So
okay, let's put it over to the two investors on the panel, Mark and Peter.
Well known.
Yeah. Felix, thank you. I mean, thanks for explaining that. It would be great to hear the two investors on the panel, Mark and Peter. Maybe Mark, we could start with you, because you have to decide how to implement smart beta approaches within the context of your broader portfolio. Could you give us your view on how to do it and what considerations you look at?
Yeah, to start with, I completely agree with Felix that it's difficult for an index provider to come up with one solution that fits any client. To honest, I think it's difficult because the solution should match exactly the investor goals, the size of the portfolio, which in our case is a problem every now and then. And especially the risk preferences, as Felix mentioned. So I don't think that there's solutions or there's products in the market that will be an index for me, but they might be interesting investment opportunities. So the way I look at solutions from index providers like MSCI, S&P, Russell, FTSE is more or less as a competitor, they do things differently, and I just think about whether I would be able to implement our strategies that way. And I find it very difficult to come up with a real benchmark or a benchmark that suits the strategies that we have built internally. It might be for low volatility, for instance, a beta-adjusted market cap portfolio or something like that. I think it would be closer to a benchmark than an MSCI low volatility strategy.
Mark, just to understand and to explain what you're doing, you're talking about strategies that you are implementing internally at PGGM, and you're looking for a kind of external index provider supplied benchmark, for a similar type of strategy against which you can, benchmark what you're doing. Is that right?
Yeah. We have made these strategies for our pension fund clients, and they would like some kind of a benchmark to see whether we come up with nice strategies. And
right.
It's kind of difficult because we built the strategies around the fact that we invest roughly 10% of our assets in these alternative equity betas. So it's quite a large amount. And so we can't do exactly the same as some index providers offer just because of liquidity. And
right.
So we have to limit turnover, and we have different risk preferences. I would say on average our goals are first risk reduction, secondly need to do that with a limited turnover, and only thirdly we would like to get some additional return over market cap. So it's our setting is different in that sense.
Okay. Thank you for explaining that. Peter, how do you do it at Seven Investment Management? What are the key considerations for you?
Kind of the reverse of Mark, performance, return and turnover. We've implemented about 30% of our equity portfolio in very smart beta products, principally maximum diversification from TOBAM, equal risk weight, and some, not equal risk weight, risk weighted and equal weight strategies. We also have a maximum diversification commodity strategy, which is working extremely well. And in the fixed income space, we have the PIMCO GDP weighted emerging markets product, which is also performing very well year to date. And really what we're trying to do is add some value to our customer over and above the market cap weight. It's preferable but not always achievable with things like equal weight, that we reduce the volatility, and we've certainly done that with the TOBAM products and the PIMCO products. And the turnover is not such a concern because we're buying TOBAM funds and so on. So turnover kind of feeds back into return. And obviously, we're looking very closely at momentum strategies right now, and what we are trying to implement with a momentum strategy is a hedge for some of our strategies, a different source of return, if you wish. But we also have to play that with minimizing the turnover.
Both you, Peter, you and Mark have mentioned turnover, and Felix, I have a question for you. This is one that's coming from one of the attendees as well. Someone's pointed out that as soon as you depart from cap weighting, you start generating higher turnover and potentially much higher trading costs in any smart beta index. So have you included trading and market impact costs in the comparisons you're making?
Yeah, this is a relevant point. So in the illustrations that I've been showing, I actually used implementations that are turnover controlled. So these are controlled to have to not exceed a 30% annual turnover. And they implemented in very kind of large cap or large cap universes, so that the transaction costs would not have a strong impact on these results. But I think yes, in general, this is an important aspect, and it should it's part of what providers should report on these strategies.
Okay, so to understand, you've done some, you've implemented some turnover controls to limit turnover in the indices you've shown, but the turnover costs, related turnover costs, are not actually shown in the return figures.
No, here we don't show the turnover cost. So we've done, I mean, we've published this in the kind of papers underlying these strategies. So what you can do, for example, the problem with transaction costs, they depend on the investor and how you implement it. But for example, we've calculated kind of indifferent transaction costs of what is the level that you would have to pay to cancel the benefits, which we put around 12% transaction costs, which is unreasonably high. But among index providers, since the transaction cost will depend on how you implement it and who you are, it's standard to actually not adjust the performance, if you will, for these transaction costs.
I mean, I'd like to address to all of you what I think is an important point. And I mean, Felix, you've kind of pointed to that question by talking about some of your, relative risk controls, like tracking error controls. But I mean, if you think of a typical pension fund, where they've historically just outsourced everything to active managers or to a consultant who then chooses active managers, there's a kind of chain of command and people have lines of responsibility. But how, what's the governance framework for a fund that's using smart beta? Because everything then, if you're the CIO, you choose one of these strategies and it goes wrong. It's you carry the can, and it's sometimes difficult to explain. What kind of governance framework is needed for this type of fund? I'd be interested in your views. Maybe first Felix, and then perhaps Mark and Peter in order.
Well, I think what you say is right, and I think it's the reason that in practice a lot of investors are still hesitant to adopt these, because you will have direct responsibility for this change of the benchmark, and it's typically a very high-level decision that of course will have to be improved by let's say the board of trustees in a pension fund. And I think in terms of governance, what is really important is that like the investment management professionals who adopt these, they actually communicate very clearly on what are the risks, so that this choice is really made in full knowledge of these risks. And for example, looking at these relative risk numbers, I think is already instructive. And I think they should be reported much more frequently by providers. What is the maximum relative drawdown that you had over the period, for example? This is clearly important information.
Right. Mark, and what are your views on the topic?
Well, I think you're right that there is some sensitivity to CIOs becoming responsible for the performance, but I think crucial point is that you get your clients aligned with what you expect the risk and returns to be. So if you look at the low volatility anomaly, you shouldn't expect to do well in years of markets going up. So before you build this kind of products at a pension fund, you should make sure that the board of a pension fund is exactly clear with the profile, not that much the risk return, but it's actually very useful in a pension fund environment because of the long-term investment horizon. They will be able to see the long-term benefit of such a strategy, but you need to make clear that there will be years of underperformance and maybe 4 years in a row. So I think the main responsibility is it's not that much governance. It's really getting your clients aligned with the risk return profile.
Right. Peter, how do you do it? Because some of these strategies are quite complex to explain. I'm thinking of things like maximum diversification. How do you inform your clients of what you're investing in and how long it might take for it to work?
We certainly inform them, but as a commercial organisation rather than an academic organisation, I'm in the risk-taking business. And so I'm expected to take risk. So the idea of reputation risk, or however Felix defined it, that's what our job is. So internally we spent 6 months dancing around TOBAM before we actually pulled the trigger and bought that, and that's our judicious process. We built up an internal consensus, made sure we were committed to the strategy, and when we executed the strategy or bought the funds, we made sure that our clients knew and understood it, and our salespeople understood it, and we got excellent support from the TOBAM staff in educating our sales force who are out on the road meeting customers.
Right. Okay. Well, thank you very much for your comments, Felix, Mark, and Peter. I'm afraid we haven't had time to answer all the questions that came in. We had a number that we just didn't get time to address. But perhaps those sending those in can follow up individually with the panelists afterwards. I'd be very happy to direct those questions if you'd like to email us at Index Universe. I'd also like to point out that the recording of the webinar and the slides will be put on the indexuniverse.eu next week, so you'll be able to view the webinar again in replay and also to see the full range of slides from next week. And with that, I'd like to thank you for your time this Friday, and a particular thanks to all the panelists, Felix, Mark, and Peter. Thank you for participating.